Do you ever wonder how real estate investors pick the winning properties? The secret really is in the underwriting or the process of creating financial projections of a property's future cash flows and net operating income. While these loose definitions seem simple on the surface, there are a lot of variables at play and economic conditions to consider that can make or break a potential investment. So make sure to stick around because in today's video, I'm breaking down the basics of underwriting in commercial real estate. All right, well, let's talk about and define truly what underwriting is, right? So underwriting is the process where a individual investor or a firm like ours is evaluating a property. Now, part of that goes into understanding what makes up the property itself, the sticks and the bricks, the actual location of the property, what are the income drivers for the property, both in the present and in the future. Let me just make something clear here. The underwriting is not just static about today. It's static for today, but it's dynamic about looking ahead over your investment timeline. So within that, you're looking at both the sticks and the bricks, the physical location, the present income today, the possibilities of the operation, the income and the opportunities in the 1, 2, 3, 4, 5 years that your investment time horizon would be. It's also looking at and understanding the current lending environment, interest rate environment, microeconomy environment, and cap rate environment, and how all those variables come together to distinguish what is a good deal, a bad deal, and a great deal. And there's a lot of pieces to it. So we're going to break it down section by section, step by step, and take a look at it. Because again, I would tell you this, it's one of the absolute most important pieces in the real estate acquisition. I can tell you now with absolute certainty, I've seen guys that maybe didn't know what to do or they haven't been through full cycle environments, kind of fudge the numbers, if you will, and now they're paying the price for it. So make sure to really understand this critical piece. So, just to be clear, in underwriting, it really is evaluating a property and its investment success or lack therein, given a backdrop of all different market possibilities. And so you have to take a look at it and understand where you're at in the investment cycle. What does the property look like? What are your opportunities within that property? And all of that is being looked at against the backdrop of what's going on in the macroeconomy, right? Because the macroeconomy, as you're going to see in some of these financial metrics, has a real impact on what your success or failure can be. So super critical to understanding that as it relates to your overall underwriting. So with that, there are key financial metrics that we look at that are critical in the underwriting process. When you're underwriting a commercial real estate asset, like an apartment community or even a storage facility, you're looking at it as a business to evaluate, can it succeed? Can you increase its success? And one of those key financial metrics is the net operating income. Most commercial real estate valuation is heavily driven by how much net operating income you have, and are you growing that income? And then that's typically divided by the current market cap rate. So let's talk about the net operating income. You've got to look at what are you getting right now on the property, and do you have reasonable expectation and business plans to be able to increase that operating income. So now for many of us in our projects, they're value add programs where we know that we can increase the operating income because we're making significant improvements to the overall property or community. We're improving the actual apartment itself. And so that enables us to drive rent from $850 to $1,150. And again, now you're able to see, okay, if I've got 100 units, I'm increasing each one by $300 per month. So over the next 12 months, I can renovate 50% of the property or 70% of the property. It's important to understand that even for us, we, for the purpose of being secure and conservative, we renovate the units on the turn. So on that 100 unit apartment community, we're not renovating all 100 units in the first year because you're keeping quality tenants, raising their rent, yes, but it provides stability. So, that's a manner with which you can see this is a proven pathway to increasing operating income, which is going to increase the value of my property over time. That leads us to vacancy. Vacancy is a critical factor because, again, if you are, stating that you've got a 2% vacancy, but yet you're heavily turning over the demographics of the apartment, those two things don't go hand in hand together. So again, maybe it is in that first year, you've got to allocate a higher vacancy because you're having more turnover by design to renovate the units and then bring them out at market rate. And so again, the higher your vacancy, the lower your operating income. Again, and that just makes sense because if you've got vacant units, you're not collecting income on them. So you also got to get dialed in on your turn or renovation time frame so that you're decreasing your vacancy. So I mentioned before about your operating income and deriving value by the cap rate. The cap rate is a very critical component. And so you look at what is your going in cap rate for the market. So the market establishes by supply and demand constraints and overall macro market conditions, what is a standardized cap rate, meaning capitalization rate going in. So in some markets before it was 4%, now it's 5%, other markets it's 6% as a standard when dealing with, say, apartment communities. I can't speak of every market, every location because they vary by market and location. But so, unfortunately what's happened is, and again, in recent times, where people underwrote in, let's say, for example, a market in Georgia or Florida or Texas, where the cap rate maybe at the moment in time was 4.25%. That was the going in cap rate. Well, when we're underwriting, you have to understand that you're going to hold the property for a period of time. Typically for us, it's a 3-year target, can be 5 years, but usually that 3-year is a window of execution that is we've been able to successfully achieve, and it gives us the time frame to operate and to get the project done. Now within that, we also account for an expansion of the cap rate, meaning every year that we hold it, the cap rate's growing by, typically 25 basis points, depending on the project, maybe even 33 basis points, so that over a 3-year period, your cap rate's expanded by 1%. So if the market was 4.5%, we're underwriting to a 5.5% cap exit X rate. And that was historically done even during times when cap rates were decreasing under an expansion market conditions. I think what we've also seen, though, in the recent times is, unfortunately, people bought properties at a 4.5 cap. They underwrote that they were going to sell it at 4.75 cap, meaning no real substantial change in the market. And now those markets are at a 6 cap. So what has that done? It's decreased the value of the property. They bought it for X price, assuming to sell it for X price. And unfortunately, the cap rate has risen and they didn't account for that. And now they're not going to get this price. They're going to get this price, and ultimately it looks like they may break even or lose money. So it's a critical component to be able to understand how the cap rate works, but also importantly, to be able to underwrite it correctly. Equally with that is your financing terms, right? Super critical in your underwriting to be able to understand, here's where we're at in our current financial times, current interest rate. And then whether it's a fixed rate loan, whether it's a variable rate loan that you're going to buy a rate cap on. And then also equally of importance, in today's moment right now, Fannie Mae, Freddie Mac on your probably roundabout best day, you're getting 6.5. Bridge loan could be anywhere from a bank at 7.5 to bridge bank debt at 8.5, 9.5. So those are, big swings on rates. And then you have to look at both what does that mean for our hold period? And then also when we go to sell it, what is our buyer getting as a rate, right? Are we expecting that rates will be down at that time? Are we expecting rates will be the same at that time? Or are we expecting rates to go up? Now, again, what's happened recently where in, say, the last 2 years where people bought a project, expected rates to stay the same, and they were going to sell at the same rate, and now rates have gone up, that's diminished their value. So again, you can see that the financing terms are critical. Also to that end, it's also important to understand if you had a variable rate loan, meaning a bridge debt type loan, but even if you had a rate cap in, what those financing terms are. Is it a 3-year fixed period, 2-year fixed period? How long does the rate cap go for? These are all critical items that need to be included and addressed in your underwriting. Let me just highlight two other things that are super critical, and that's your rent growth and expenses. So these are areas that are super important that I think, unfortunately, many people have, kind of fudged the numbers. What I mean by that, when we look at a property and you go into underwriting, you look at the historical past 10 years, what's the average rent growth been for that market? And in many places, you're going to find, at least where we invest, it's around 2%. So as a conservative measure, you want to make sure that your future rent growth is based on the historical 10-year average, not just a blip that what happened. Like 2020, many markets, including markets we're in, were up 20%. And even some places, they had a forward look of, okay, rent growth is going to be up 4 or 5%. So they bought the property, underwrote rent growth at 5% over the next 4 years, and then lo and behold, we're moving into a potential recessionary time and rent growth is flat. So that's really going to hurt them as it relates to their valuation because they're not going to keep compounding that rent growth. Similarly, expenses are critical. You can't just say on a wholesale basis, we're going to go in and just cut all expenses by a third so that it improves your overall underwriting metrics, because that's just not real. If you say that your average salary for manager and maintenance guy is $110,000 all in at a 100-unit property, you're not just going to be able to cut that to $70,000 because you're not going to be able to hire anybody. And so it's critical to be honest with these figures, or maybe honest is not the right word, but again, like not overzealous in trying to push the needle, because that's where you do that and you get hurt. Unfortunately, we're going to see in 2024 people that are going to get hurt in the selling of their properties because they weren't true to the numbers. One of our previous videos, we talked about real estate cycles, and it's important to understand where you're at in the real estate cycle, but also understand the macroeconomic factors that may impact you during your investment hold period. That all goes into the underwriting and assessment. So again, you have to understand, like what we've seen in the most recent environment, this increasing interest rate environment, what effect that has. Also, when you're looking at a property, looking at understanding the demographic in migration, right? Like there are certain areas in the country where people are moving away from. So it's awfully tough to write in your underwriting that you're going to have growing demand and growing rent growth when people are moving away. And so that's a critical factor. As we touched on before, the impact of interest rates and cap rates is really critical, and that's driven by what's going on in the macroeconomic backdrop. I mean, let me just tell you this. One of the things, my 19-year-old daughter that is a part of this firm, and she's finishing her degree at college. She's got less than a year left in that. I'm also introducing to her a daily reading of the Wall Street Journal, daily intaking of macroeconomic news, because you've got to begin to understand what's going on. And I'm here to tell you, unfortunately, there's a lot of people out there that don't really have that background and understanding. Now, fortunately for me, as I shared with you before, I'm a stockbroker. I've been a stockbroker for 20 years. I have a degree in finance, a degree in economics. And so that's been something that's always been part of my wheelhouse and focus. And it's super critical because, when you go into this underwriting and you look at a particular asset in a particular location, you've got to understand what's going on over the next 2 to 3 years in the macroeconomy. What do you reasonably expect interest rates to do? What do you reasonably expect cap rates to do based on the macroeconomic conditions? And then also understanding the underlying factors of that submarket. Are people in migrating in there? Are employers coming into the market? Is there an overreach of supply? These are all things that affect you. And if you don't understand these components, you could make wrong or false assumptions based on that lack of understanding. And so I've seen that where, and again, I'm sure that many of the guys that did the underwriting didn't have a malice intent, but they had a lack of understanding because they hadn't been through full market cycles. And so they didn't pay attention to things that now in 2023, heading into 2024, they wish they would have. And so these are critical and most important things that we got to take and stay focused on. So now, clearly, once you've got these pieces put together, it's important that you take a look at the whole of your underwriting. And then not only have you understood the macro factors that are affecting you, and then the actual financial metrics that comprise the property, but now you also stress test the project to see what can it withstand, what can it, at this price of acquisition, can it withstand a 25% vacancy? Can it withstand interest rate movement going up to this? These are what are stress testing or sensitivity analysis that's also critical to understand, because you want to look at your planned execution. You also want to see what is the best case scenario, and then also what is something that could be the worst case scenario. Because look, you need to be able to survive during the worst case scenario. And that's not, look, I'm an optimistic person, I'm a faith-based person, but I'm also a realistic person. And so as an investor who's prudent and conservative, been doing this for over 20 years, you've got to take these things into account. And so again, if you don't have that information or that understanding going into it, you're really deficient on what you should be doing to de-risk the project or de-risk your actual investment. So, and again, as we talk about the overall value of underwriting, this is where it's important, extremely important to be patient, right? Because market cycles change, and depending on those market cycles, that's where, again, you've got to understand what's going on and be patient. In the most recent term, we've seen these interest rates that have gone up along with inflation. That's affected the ability to execute on good quality deals. And look, it's always better to not do a deal than to do a deal that you later regret. And again, I learned that lesson, critical lesson, going through the 2008, 2009 recession, the Great Recession, that there was properties I wished that I hadn't bought. And so through that period of time, it helped us to become super strategic and very intentional. And that's what I want for you as you understand the importance of underwriting and who you're investing with. That's all I have for you today. If you're interested in investing in multifamily real estate with me, click the link in the description of this video to join our investor club and get early access to off-market multifamily investment opportunities. Thanks for watching. Make sure to like this video and subscribe to my channel for more content on real estate investing. See you in the next video.